Okay, hello and welcome to the Mona School of Business and Management online forum. I'm your host and moderator for this afternoon session. I'm Indiana Minto Coy. It is indeed a pleasure to have you. Thank you so much for taking the time to join us for today's session, which is titled, Do Financial Markets Bear the Cost of Curbing Government Fiscal Indiscipline? Global Evidence from Fiscal Councils with Implications for Jamaica. And of course, our esteemed presenter is here, Professor Delroy Hunter. Before we go into our presentation, I want to invite our head of school, Dr. David McBean, who will bring a few words of greetings to you before we get going. But before Dr. McBean comes in, I also want to pause to welcome those of you who are joining us on Facebook Live. Feel free to send your comments, questions at any point along the way, and we'll take them at the end of Professor Hunter's presentation. Of course, we have our colleagues who are also on Facebook, so please feel free to send any comments or questions you may have throughout the session. So, without further ado, I now invite our Executive Director, Dr. David McBean, to bring even warmer words of welcome to you. Thank you.
Thank you very much, Indiana. And a warm welcome to the participants today. Thank you for coming to another in our series of presentations from MSBM. I'm delighted to be asked to do some introductory remarks for this presentation. Professor Delroy Hunter, who is one of us from MSBM and is now the Serge Bonanni, and I hope I pronounced that correctly, Delroy, professor at Muma College, University of South Florida, decided to spend his research time with us at MSBM, and we are very grateful that he would have chosen MSBM to do research for his Fulbright scholarship. The topic itself is particularly pertinent for the Caribbean and Jamaica in particular. We have been suffering from government fiscal indiscipline for a long time, and we often adopt mechanisms from outside Jamaica to try and help to solve our problems. So looking at fiscal councils and how they perform, I think has a lot of relevance, and I hope that this research makes it into the policy arena for consideration, Delroy. The research spans looking at over 4 decades of data. It looks at countries, and I'm not stealing Delroy's thunder in his presentation, so I'll be very brief, but the fact that he's looking at countries who have experienced 1 episode of 5 consecutive years of budget deficits, and Jamaica easily fits into that scenario. So it is part of a debate and a discussion. I think we'll put our toes in the water to some extent, not a full fiscal council, but certainly our epoch was a nudge in that direction. And so I look forward to Delroy's presentation and looking at how fiscal councils affect performance. So Delroy, once again, welcome. Thank you for coming back home. And once you hear him speak, you'll understand that it's not just MSBM home, but Jamaica home. And like myself, we hail from the western end of the half of the island. And so thank you very much for sharing your time. And once again, a warm welcome to all of the participants, and a big thank you to the MSBM team for helping to put this together. Thank you.
Thank you so much, Dr. McBean. And so without further ado, you all came to hear Professor Hunter, and it is my esteemed privilege, in fact, to introduce him officially. So of course, Dr. McBean just mentioned, Professor Hunter is the Serge Bonanni Professor of International Finance at the University of South Florida. He is one of our own, having completed his undergraduate degree in management here at the University of the West Indies Mona campus. He did his PhD in finance at the University of Warwick in the UK, where he was a Commonwealth Scholar. And of course, he's also a Fulbright Research Scholar awardee, having spent the time between January to May of this year, just recently returned to the US, conducting his Fulbright research here. Professor Hunter has published extensively and has won several awards for his research, including the Goldman Sachs Quant Award for Research in Investments, with his work, of course, being listed among the working papers of central banks and money management firms. And so I'm giving you the shortened version of the bio. Just to add that Professor Hunter is also an associate editor for the Journal of Financial Stability and of Quarterly Journal of Finance and Accounting. He has received training in management consulting, entrepreneurship, small business management and development, and hotel management. And of course, he has his experience and expertise as a consultant. And so without further ado, as mentioned prior, please feel free to put your comments, your questions in the chat, both on Facebook and here on Zoom. And we will address the questions after the presentation. And so now, please, Professor Hunter, we welcome you and we look forward to your presentation. So over to you.
Thank you very much for the warm welcome. All right, let me take a half a minute to say thanks to everyone who has turned up to the seminar. This should have happened in the earlier part of the month, but I'm happy that it's happening now. The topic, as was stated, is do financial markets bear the cost of curbing government fiscal indiscipline? And to answer this question, I am focusing on fiscal councils with implications for Jamaica. When I decided to apply for the Fulbright scholarship, I realized that as a Jamaican applying to return to Jamaica would have reduced the probability of being successful with the Fulbright, because there's a cultural aspect to the Fulbright. But I decided that I wanted to spend my time in Jamaica and to do some research that is of relevance to Jamaica. In case you're not aware, Jamaica is in the process of introducing a fiscal council. And let me say briefly what a fiscal council is. So the fiscal council is a legal and operationally independent entity in the sense that it should be given legal backing, and it should have its own staff, its own budget. And the goals are to attempt to impose some fiscal discipline on the government by, for instance, assisting in assessing government budgets, expenditure, plans for taxation, and even to do its own forecast of revenues and taxes. The Fiscal Council is to some extent like EPOC. Some of you are aware of EPOC, that provides guidelines and oversight on how the government manages its programs with the International Monetary Fund. This topic is of relevance to us because the fiscal policy of any government has really important effects on many aspects of the operations of the country. For instance, fiscal policy affects the investment or borrowing choice of corporations and the extent to which individuals save or consume, and also affects various macroeconomic outcomes. It is perhaps one of the most important operations of the government. Now, fiscal deficits occur when governments spend more than they take in taxes and by other means. What we have observed is that over the last 4 decades, the World Bank data that I have used in this study indicates that at least 160 countries have had chronic fiscal deficits where they are spending more than they're earning consecutively for at least a 5-year period. But this is not something that is only of academic interest. So recently, both policymakers and academics have begun to look at the effects of the fiscal deficits and the announcements of fiscal spending on financial markets. And they have generally focused on the bond market, the stock markets, exchange rates. And here are a few papers, clearly are not all academics, but these are some of the top journals that academics aspire to publish in: Journal of Financial Economics, Journal of Monetary Economics, Journal of Political Economy, and so on. So these policymakers and academics have been assessing the effects of fiscal indiscipline and the outcome of that, fiscal deficits and financial markets and assets. The consensus essentially is that fiscal deficits and the announcement of deficit spending and the attendant fiscal uncertainty has a negative impact on asset prices and the risk premiums in asset returns. Now, risk premiums are just the extra compensation that investors ask for when you try to induce an investor to part with his or her money to invest in a particular company or government bonds, etc. So the consensus is that fiscal deficits has negative consequences in the financial markets. This leads to a question: what if we were to impose more restrictions on the government by instituting some mechanism that constrains the spending and perhaps increase the revenues? However, to date, there's no empirical evidence on what happens, and the theory which could guide us in the absence of empirical evidence is mixed. There are contrasting views on whether there could be some kind of negative or positive outcomes if you try to constrain fiscal indiscipline. What we have observed in the last 15 or so years is that a large number of countries have moved to institute a fiscal council as a constraining mechanism on government fiscal policy. And about half of this number are European countries, but the other half are spread over a large number of countries. Prior to the last decade, 2 decades, other countries like the United States have had these fiscal councils, but they are growing increasingly popular now. The question arises, however, is if you establish a fiscal council, could this cure create its own side effects? Could the establishment of a fiscal council by a particular country in an attempt to restrain government spending and to increase government intake of taxes create financial side effects? More specifically, the research question is, do fiscal councils retard financial markets? Let me just take a minute to sketch out the hypotheses There's a lot of detail in the rough draft of the paper that I have. You can ask me more in the question and answer session if you wish to. The interesting thing about this topic, when I was thinking about it, is that if we find that fiscal councils retard financial markets, there's a set of policy implications. On the other hand, if we find that fiscal councils enhance financial development, there are also policy implications. And one immediate implication that would have for Jamaica is that it could provide the Minister of Finance with some encouragement, if he needs it, to say implementing fiscal councils not only give rise to the specific and direct objectives, but they also lead us in a direction that have significant implications for the overall economy, which I'll talk to in a minute. So the first hypothesis, the null hypothesis, the one that going into the research, I am thinking is perhaps going to be rejected. And this is not what many people expect. So the idea here is that fiscal councils could increase financial development by reducing spending, increasing revenues of the government. The immediate effect of this, especially for those who are economists, is that there'll be a reduction of what we call the crowding out effect, where government borrowing crowds out the private sector from the financial markets. If the government raises more revenues than prior to the implementation of a fiscal council, then the government need not raise as much capital as before, which means the government will be supplying the markets with fewer financial instruments, treasury bonds, treasury bills, etc. That has implications for our investors invest. Investors would, for instance, be searching for alternative investments and may be induced to take on investments in riskier securities like the stocks and bonds issued by corporate entities in an attempt to raise capital to expand production. So the allocation to more risky capital could redound to greater economic development and would be the result of increased financial development. The uncertainty surrounding fiscal deficits, the uncertainty of whether there will be new taxes, the uncertainty of whether the government will borrow more and will cause inflation, increase interest rates, etc. These uncertainties could be reduced in the presence of a fiscal council, and therefore, if there are reduced uncertainties, the implication of that is that investors should be demanding less risk premium on government securities, and there may even be spillover to privately issued securities. On the other hand, the alternative hypothesis says that fiscal councils retard financial markets. Recent evidence in the US indicates that government spending has important implications for participation in financial markets and for asset prices, in the sense that if government provides some kind of subsidy transfers, they're called transfers, for instance, monthly checks to some individuals who may wish to participate in financial markets, or if government provides support for certain kinds of investments, then these can actually lead to an increase in financial development. So the idea here in the alternative hypothesis is that if the government, because of the restrictions imposed by the Fiscal Council, constrains consumption by reducing the government's own consumption and more so consumption expenditure, let that be clear. If the government reduces consumption expenditure and therefore individuals or entities that would have relied on government to some extent for their revenues are faced with less inflows from the government. They may have to dig deeper into their savings, into their investments in order to maintain a certain level of consumption. Hence, fiscal councils could lead to a reduction in consumption through an increase in taxes and a reduction in government consumption expenditure. And they together can lead to a reduction in total consumption in the economy. As you know, firms' cash flows are dependent on consumption. When consumers purchase goods and services, that leads to increases in the cash flows of firms. To the extent that firms are not obtaining the same level of cash flows after the introduction of a fiscal council, you could find that fewer firms are interested in investing or listing on stock markets, for instance. Someone has have a microphone open. So the greatest winner in the history. Can the host quiet that microphone for me, please?
You're fine now, Delroy.
Please unmute, Delroy.
An obvious question that you may ask me is why financial development? Why focus on financial development rather than some other macroeconomic outcomes, GDP growth rate, exchange rate, etc.? And other than saying that it's one of my favorite areas of research, the reason is that developed financial markets play critical roles in the economy. For instance, through developed financial markets, we can stimulate savings, facilitate information sharing. Companies provide information which allows investors to make efficient choices. And in making efficient choices, they allocate capital to companies with best potential outcomes. Financial markets also allow you to manage risk. For instance, if you have only stocks issued in a particular market, there are some entities, some investors that will shy away from investing in stocks because they're too risky. But if you introduce other securities like treasury securities and so on that are less risky, or if you introduce other financial derivatives, for instance, that can be used to manage risk, more participation will be induced. Financial development also fosters economic growth. There's no fairly robust empirical evidence emerging. This has been around for the last 30 years, whether financial development induces and causes economic growth. The robust evidence is just now emerging with new statistical techniques and data, etc. And then financial development increases social welfare. For instance, we noticed recently when the government was providing some kind of subsidy as a result of the COVID outbreak, there were people standing up in lines and there were people who were probably discouraged from obtaining this payout, this transfer from the government, because they were not part of the financial system. The above notwithstanding, it should be noted that greater financial market participation created by financial councils, I call them FCs going forward, by financial councils could actually have a negative effect on financial development. For instance, one quick example is that if you have a lot of credit being introduced to the private sector as a result of government reduction in borrowing, that could lead to significant increase in, say, real estate investment. But investments now can lead to future depression in prices, which could lead to real estate crises as we observed in the 2000s in the US. So the Fiscal Council and the financial development that it could induce could also create its own negative, or what we call negative externalities.
Hello?
Dr. Matt Bean, you're unmuted.
To conduct this study, I need several databases. First, I have an index of financial development from the IMF, and it ranges between 0 and 1. So 0, you have not met any of the goals of financial development. 1, you have met some of these goals. So 0, you have met none. 1, you have met all, and anywhere in between means that you are on your way towards a higher level of financial development. Fiscal councils, that information is from the IMF also. Currently, there are 49 countries with 51 fiscal councils up to the end of 2021. I also need some information from the individual countries, and there are some other pieces of data that we also require for this study. Here's a schema indicating this financial development index. So we have an overall financial development index, and you'll see what goes into the index in a little bit. And then the index is decomposed into a component that affects financial institutions like banks and financial markets like stock markets, for instance. And then to get a clearer picture of the development, they look at the depth, the access, and the efficiency of financial markets. Depth would mean the number and volume of securities that are available for trading. Access would mean the ease of investors using these financial services. And efficiency would, in some sense, mean that you can engage in transactions in the financial markets, and these are not at the very highest level of transactions cost. So from this, you can see that we have 9 different indices or sub-indices, and I will consider each of them as I proceed. Here's some definitions of the different aspects of the financial markets. So we have financial institutions, financial markets, along the dimensions of depth, access, and efficiency. So for instance, private credit would be an important component. Pension fund assets, mutual fund assets, insurance premiums. The more of these you have, and the greater the proportion relative to your GDP, that would be a deeper market. And we will call that subindex FID, financial institutions, and the depth component. Similarly, you have an efficiency component, where, for instance, you look at banks making net interest margin, the difference between the lending and the deposit rates, non-interest income to total income, or stock market turnover, the volume of stocks traded or the value of stocks traded to market capitalization. So these are important aspects. And in the past, when we did research on financial development, what we did was to take an ad hoc number of these variables, like private sector credit to GDP and stock market turnover, I have used in previous research. The IMF has systematically created these indices over the last 40 years from 1980 for about 185 countries that are used in the sample. Here's a quick table, summary financial development. So the overall index, FD, is 0.248. So that's about a quarter of the highest level that one can reach. And that's for all the 7,360 so-called country year. So this is a country in any given year. So one country will have 40 observations in the sample, or 10 or 15, depending on how long the data is available for. Just to note that Jamaica has about an average value of about 0.25, so similar to the average here. And one thing to note is that the financial institutions aspect of financial development is about twice that of financial markets development. So there's more in terms of the financial market development, the financial institutions development relative to the financial markets development. And that is perhaps not unexpected, because many countries start out as being bank-centered, where banks play an important role, and then we have pension funds and insurance companies and so on. And it is only over time and starting at some later point that we have a development in, say, stock markets. It is important that we bear in mind here that the variation in the mean just simply means that different segments of the financial market overall develop at different levels. And these numbers, I won't refer to them, I won't get back to this slide, but these numbers are important in demonstrating the effect of fiscal councils. So I want to bring your attention to, for instance, again, the financial development overall average index value between 0 and 1 over the entire sample for all countries is about quarter of the maximum. And for the financial institutions access, the access to financial institutions is about 0.263. Those are two numbers that we'll use in a little bit. Here's a picture of fiscal councils around the world. And these fiscal councils that are in the darker shades, as you can see, are to some extent concentrated in Europe, up here, but they are scattered in North America, some in South America, a few in Africa, Australia, and a handful in Asia. So there's a reasonable distribution of these fiscal councils, but the fact that they are primarily concentrated in Europe poses a little bit of problem in terms of the analysis that we do, but we found some ways to get around that. This is just a chart to show you graphically the point at which different countries introduce fiscal councils. So if you notice at the bottom, 4 countries, maybe a little difficult to see, Netherlands, Denmark, Austria, and the USA had fiscal councils prior to 1980, but everything else in the sample introduced fiscal councils subsequently. So the green will represent the duration of the countries in the sample. That is the post-fiscal council period, whereas the other color represents a pre-fiscal council period. Now, it is important to present a picture like this because it has a bearing on the credibility of the statistical method that I use. We want to show that because countries have this so-called staggered approach to the timing of implementing fiscal councils, they are not done all at once. We had to adjust for that in the statistics that was conducted. The other thing that needs to be noticed is that for many countries, there's a fairly significant duration in the sample, 5, 15, 10, 20 years, and that's also important. How long the country has been in the post-fiscal council period assist us in terms of the analysis, because we're looking at what happens once you have introduced fiscal councils. Since not all of us are statisticians, let me just try and explain the methodology that I use using 2 graphs. This is a standard performance evaluation method. Just think of a graph with time along the horizontal and the fiscal development index on the vertical So 0 is at the bottom, 1 is at the top. Think of a country that over the sample period of 40 years did not adopt a fiscal council, Jamaica, for instance. So if you notice over time, financial development increases for that country. Then here's another country that adopted fiscal council, and we have the vertical line in the middle here indicating the point at which the adoption took place. What this upper line tells you is that upon introduction of the fiscal council, there's a jump in the financial development index of that particular country. What the difference in difference does, which is a statistical technique, the difference in differences simply says, take the growth in the financial development in the post-fiscal council period, that is to the right of the vertical line in the middle, minus the growth in the period before for the country that adopted the fiscal council, and then do the same thing for the country that didn't adopt the fiscal council and take the difference between them. So it's a difference in differences. We have two differences. The adopting country, we call it the treated country, computing the difference between the post and the pre-fiscal council financial development index. And then we have the control country, which didn't adopt, and that's the pre, so that's the post minus the pre, and we take the difference between them. So we have the difference in two differences. Now, we can approach that using a regression equation. I'll skip over that. But here's what happened in reality. Many countries implemented fiscal councils throughout the 40-year sample at different points in time. So what we face is take that country that first implemented, let's call it an early adopter, first implemented a fiscal council, and then here's a second country that adopted a fiscal council sometime later. So we see from the green line in the middle an increase in the financial development index in the post-adoption period, the second vertical line. You would immediately say that the late adopter with the green line has a significant improvement in the financial development relative to the country that never adopted. Because you can see that this upper line here is much higher than the lower half, the lower part of the green line. And that difference in the post minus the pre would be greater than the post minus the pre for the red line, the country that didn't adopt. Except that in the past, statisticians did not bear in mind that the software they use in doing this kind of performance evaluation did not only include the control country, but also the country that was earlier treated. So if you are taking the difference between the late adopter and treating the early adopter as one of those control countries, because it wasn't treated at the same time as the late adopter, then this introduces a whole set of bias. That forces us to rethink the way we estimate this. So we have what is called a staggered difference in differences, which takes into consideration the bias, which could be positive or negative. You could end up finding something that's not there, and you could conclude that it has a negative effect when it has a positive, or a positive when it has a negative, or when it has no effect. So what we find is that if you do your statistical test using a clean sample of control countries, then you can adjust for the bias that is there. So I'm going to regress that difference in difference, the treated country after minus the treated country before, minus the control country after minus the control country before. Again, this is the same evaluation you would do if your company sent, say, half of its workers on a particular training and the other half didn't go on the training. Subsequent to the training, 6 months in, a year in, the company could evaluate their performance to see if there's a difference in the performance of those that got the training relative to those that didn't get the training. So that's the technique that I'm using. An advantage of this is when I include other things like the country fixed effects, time fixed effects, and other things, I'll explain those in a second, they allow me to make a causal statement that fiscal councils cause financial development to decline or to increase, as opposed to simply say there's a relationship or one is associated with the other. So there's a correlation, but it's not causal. Country fixed effects here simply means that we can control for anything that's fixed, any characteristic of a particular country that fixed over the sample period. For instance, if one country has a British legal system versus another country that has a Scandinavian legal system, that fixed effects that I'm accounting for takes care of differences like that. That may affect how financial development evolve over time. The time fixed effects would be accounting for any kind of global changes that affect all my sample. For instance, new developments like the internet. That has affected all countries across the world. So financial development would have benefited from the technology in the internet. However, I do not want to specifically account for that and the 10,000 other items that could have caused an effect on all countries' financial development. So we include what is called a time fixed effects. So I know that not everyone in the audience are techies or from the economics department, which do a very good job in teaching econometrics. Their econometricians are well known in different schools in the US. Let me get to the meat of the matter. The first thing that I want to do is to take a look at the overall effect of fiscal councils. That is the effect on that overall index, which we call FD. And what we are seeing here is just the results from that regression that we just saw. But what I did, I allowed the model to look at the relationships before the fiscal council, in the year the fiscal council is introduced, and in all the years subsequent to the fiscal council, but I just summarized the first 10 years. So there's a pre-treatment, and if the model works well, there should be no difference in the effects between the treated and the control countries. That's a technical requirement, and I'm happy to see here that that technical requirement is met. So there's no difference between the country that in the future became a treated country in the sense that it adopts a fiscal council and a country that didn't adopt a fiscal council over the 40 years of the sample period. And in the treatment, there's nothing that happens in the give me year of the adoption of the fiscal council. There's nothing that's happening in the overall financial development index. But in the 10 years on average, subsequent to the introduction of the fiscal council, there's a decline in the financial development at the overall level of the index. Now you might look and say, this looks small. It's a 0.014. What does that mean? Well, if you recall that the average annual financial development for the overall index was 0.248. So if you take this number relative to the 0.248, it's about 6%. What this says is that on average, in the first 10 years after the introduction of a fiscal council, there's about a 6% annual decline in financial development. That's an average for the average country in the sample. When you look at the sub-index that focuses only on the financial institutions subsector of the financial markets, the effect is also large. This is about 7% decline. And for the financial markets, FM, that includes, for instance, the stock market, there's also a decline, but that decline is immediate. So this provides us some evidence that fiscal councils have a negative effect, a retarding effect on financial development for the 185 countries that are in our sample. Let's take a look at what we call the dynamic effects. So you saw the summary table. Here's a picture of the effect. The dots represent the magnitude of the effects. They are positive above the line and negative below the line. And the bars represent confidence intervals. And the confidence intervals must be entirely above or below the line for there to be 5%, for there to be a 95% confidence that the value, the dot that corresponds to the value on the vertical is significantly different from 0. So we can see that there's a tendency immediately and after the implementation of fiscal council for a decline in the financial development index, the overall index. But that only becomes significant about 5 years out and continues to be significant and negative and growing for the next 4 years. Now you might ask, why is the immediate effect not significant, but it is significant subsequently? One reason for that is that the overall index has a number of components, some of which can't change overnight. For instance, the number of banks or the amount of assets under management by mutual funds and so on. These are not going to change overnight, but stock market trading and volume of trading and value of trading could actually change overnight. So what we're seeing here is the dynamic path of the effect of fiscal councils on financial development. It's overall negative. Let's look at the two sub-index. Here we have the financial institutions index and we have the financial markets index. For the financial institutions, it's a repeat of the prior finding. Starting about year 3, it is significantly negative and declines for the next 5, 6, 7 years before it becomes insignificant. So we can see that fiscal councils have a significant negative impact on the financial institutions sector. Now, one of the impact that this could have is that if financial councils reduce government consumption spending and therefore lead to a negative effect on savings or investments, because investors who would normally get some subsidy from the government or earn income from the government suffer a decline in their wealth or in their income. They may have to consume more of their savings, and that would mean a disintermediation effect. So you could observe closure of banks, for instance, and the reduction in the value of, say, investment and pension fund assets, etc. For the financial markets, the effect is immediate and negative. And again, stock markets and stock market characteristics dominate this component of the index. And so it is not unexpected that we have an immediate negative, an immediate effect. And here it turns out to be negative. Nothing else is significant. So we see significant difference in the behavior. For one, it's magnitudinally large and persistent. For the other, it's large, but not as large, and is not as persistent. Let's now turn to the other subcomponents of the financial market index. Here we have the financial institutions' access, financial institutions' depth, financial institution efficiency, and the same things for the financial markets. Again, we have the pre-treatment, the year of treatment, and the post-treatment. And here's a little bit of evidence that perhaps in the stock market, there might have been a little bit of anticipation, but that's not clear, that the governments may be introducing fiscal councils, and they might have positioned their portfolio to reflect that. But that's not clear why I get this marginally significant effect prior to the implementation. What we observe is that in the post-treatment period, the financial institutions' access, that component of financial development that relates to investors accessing financial services in the financial institution subsector of the market, suffers a significant decline. This is a negative 0.049, which when compared to the average yearly financial development index of 0.263, represents about a 19% decline on average over the 10 years, the first 10 years of the post-treatment period. So fiscal councils seem to have a significant effect on access to financial services. And I suspect that one reason for this is because it may induce some kind of closure of certain financial institutions arising from the fact that there may be less demand for some of these financial services. Here we have financial markets efficiency, and what we see is that there's an immediate effect and a post-treatment effect, both of which are negative. And this post-treatment effect is also large and significant compared to the mean per year financial market efficiency index value. So at this point, what we have observed is that financial markets tend to have a negative response to the introduction of fiscal councils so far as the financial development indices of financial markets are concerned. Here's a picture of the financial institutions' access. You can see that it's a significant decline, mirroring pretty much the financial institutions' overall index. For the financial institutions' debt, there's not a lot of change here. And for the financial institutions' efficiency, there's no significant effect. Turning attention to the financial markets, I will just show you the graphs. So what we observe here is that when you have a fiscal council, the financial markets component of the overall financial sector has a negative response in relation to financial markets efficiency. If you recall from the previous one of the previous slides, financial market efficiency related to the value of the trading of stocks over the total market capitalization of the stock market. And there are some interesting additional bits of information relative to this particular finding. The financial market access, little bit of change. In the fourth year, there appears to be a positive change, an increase in the access. It's 1, and I'm not sure if it's something I should hang my hat on, but there's a positive outcome at that point in time. But it's preceded and followed by negative outcomes, so it's not clear what it's indicating. Financial markets debt, there's no impact. All right, let me just take 1 minute just to summarize what we have found so far. What we have is an indication that financial markets reduce fiscal councils reduce financial market development. The question you'll ask me is why? What is the mechanism? What is the channel of this negative impact? Moderator, can you indicate how much time I have?
You're at a good point of summarizing.
Okay.
Professor.
Okay, let me just wrap up then. So the question is, why would we expect this? One reason is that we find that financial markets perhaps are responding to higher taxes, because we find that in the post-treatment period, there's a significant increase in the tax intake of governments. Private consumption also declines. And when we take total consumption, private consumption and government consumption expenditure together, there's also a significant decline. We also find that these together reduce listed domestic firms, and the credit to private sector also declines. These are corroborating a potential situation where individuals are engaging in disintermediation using the financial markets less, because the consumption reduces their ability to save. The reduction in government consumption expenditure reduces their ability to save. An interesting outcome of this research is that there appears to be no easing of the crowding out effect. Private sector doesn't get an increase in credit, and the loan risk premium, the difference between lending and loan rates and deposit rates, there's no significant effect in the post-treatment period, and it increases in the year of the implementation of the fiscal councils. So as you can see here, significant increase in taxes and a decrease in the total consumption as a result of fiscal councils. Similarly, you can see here that the listed number of domestic companies decreased, and it's a significant decrease. It's about 130 companies on average, but this may be skewed by some larger economies with larger stock markets. Now, there's no need to despair, because you can, to some extent, reverse these negative effects by the so-called fiscal council architecture, the design features. So I estimated a relationship that looks at the design feature and whether it has an impact on that financial development index. And what we find is that there are several components of the design, the architecture of the fiscal councils that can have a positive impact. For instance, they engage in positive analysis, just analyzing and assessing forecasts and so on by the government, making recommendations, doing their own forecast of revenues, of expenses, taxes, etc. Engaging with the public, make the reports public, and ensuring that the forecasts that they prepare are binding on the government. these particular characteristics of fiscal councils can help to keep the council, keep the fiscal indiscipline of government in check, and that can lead to positive outcomes. Let me just turn quickly to implications for Jamaica. Before I do that, let me say that the results are robust to a number of changes. For instance, if we only focus on Europe, the results hold. If we focus on the non-Europe sample, the results hold. So we can't say, for instance, it's because of the large European markets why it holds. Here's a picture of the Financial Development Index of the USA in green and Jamaica in red over the 40 years. Hardly any change in the index for Jamaica, and a significant decline in the 1990s. So fiscal councils can actually have significant negative outcomes, and potentially so for lower financial development countries such as Jamaica and other developing countries. So what are some of the implications for Jamaica? Well, fiscal councils, existing research has shown, achieve some of the primary goals: better forecast, less forecasting error, greater budget surplus, etc. However, there must be a buyer beware. There are potential negative externalities, as I have documented just now. So going into fiscal councils, you need to be aware of the negative externalities. But you can address some of these by the mandates that the fiscal councils have, and also by the so-called commitment technologies, just a fancy term that the IMF uses. It essentially means the legal restrictions, the operational restrictions, the mandates, the tasks that they're given in order to ensure that government stick to what they commit to. So pre-commitments must be followed up, and the structuring of the fiscal council can actually ensure that commitments are kept. And those can improve the outcomes that we have observed. So Jamaica is in the process of legislation for a fiscal council. And so these are some things that I'm sure they are taking into consideration. The other important thing is that the human resource choices must be done judiciously, because these choices will have a direct bearing on how well the mandates are carried out. Forecasting, assessing forecasts, etc. These have to be appropriately staffed in order to achieve even just the direct outcomes that are associated with fiscal councils. You should also ensure that fiscal councils allow other parties that are not necessarily experts, but who are advocates for financial markets and financial market developments, while at the same time, there are other levels of financial development that governments can make sure that they manipulate or manage in order to influence financial development. For instance, listing of government property, government entities on the stock markets rather than selling them to private entities that are not publicly listed. Now, it is not clear whether or not government consumption will directly affect financial market participation in a country like Jamaica. I think the stock market has probably 30,000 participants. I do not think these are people who are depending on handouts from governments, but there may be some indirect effect. In fact, some of these entities that participate in the stock market may benefit from government funding of projects and so on, so government spending, but not necessarily government consumption expenditure might not have a direct, might influence how these people participate. But I think indirectly, through consumption demand, you could have an effect. And so that has to be taken into consideration. For instance, governments might, as they did recently and are perhaps doing as we speak, engage in counter-cyclical spending, where they spend more when times are hard by providing subsidies, etc. Thank you, and I'm ready to take your questions.
Thank you very much, Prof. Hunter. Listening to you, I admit I regret not taking my statistics courses a little more seriously. But time is about spent, and I know that we have questions here, and I can see already Denzel Williams, Professor Denzel Williams, thank you for joining us, who has his hand up. So you can go ahead with your question.
Go ahead, Denzel. Maybe he's on mute.
I'll ask, okay.
Go again, let him try again.
Okay, great. I'm able to unmute my mic. Thank you very much. Thank you very much, Professor Hunter. Unfortunately, I have to run, so I wanted to ask this question before I go, but thank you very much for a very comprehensive presentation, very thought-provoking as well. My question is very simple. Unfortunately, I don't want to get into the details of the research now, but we will talk more about that.
Sure.
But if you do have fiscal rules and you have a very functioning fiscal architecture, say within your Ministry of Finance,
yes,
do you actually need to have a fiscal council?
You know, that's a very good question. I've contemplated that myself. But actually what the finding shows is that fiscal councils enhance the efficacy of the fiscal rules. Fiscal councils make sure that the fiscal rules that government pre-commit to, they actually carry out their commitments. So it's more of the same to some extent, but the fiscal councils do other things. For instance, fiscal councils can do their own forecast. So fiscal councils can have significantly different functions. So for instance, fiscal rules may be to force the government to commit to debt not being above a certain level of GDP. But a fiscal council can say, your forecast of revenue this year does not make sense. Our forecast substantially understate what you have forecasted, and your expenses are likely to be larger. And if the mandate is such that the fiscal councils must be given the chance to influence the budget, then you can see that having the fiscal council can have a significantly different effect than just having fiscal rules.
Okay, thanks, Prof. Thank you.
Thank you for that question. It was an excellent presentation. Anyone else with a question for Professor Hunter? And while you think through, colleagues, Prof. Hunter, bearing in mind the question that was just asked and your response as well, I'm wondering, is there almost like a function that goes beyond the economic to relate to even democratic governance function for fiscal councils, which is certainly beyond much of the role that you've been talking about that they can perform, certainly in developing societies such as Jamaica's.
So if I understand you, you're talking about fiscal councils having an effect on governance?
Yes,
Yes.
in terms of good governance, yes.
Yes, so that is a important, I should say, side effect, because one of the mandate of well-structured fiscal councils is to communicate with the public so that it reduces the asymmetric information between governments and the budget, about the budget, and the rest of the society. So governments put their budgets together, but we don't typically see some of the inputs and assumptions that they make. And so the fiscal councils tend to democratize that, make that public. And one of the potential outcomes is that there should be a cost, a political cost, when fiscal councils are established, but their advice is not taken into consideration and the rules and mandates are breached.
Thank you.
So to that extent, yes, they can improve governance.
Okay, thank you very much. And I see Candia Brim. I'm going to ask IT just to allow her to open her mic, please.
Yeah, everyone can open their mic. Not sure.
Thank you.
Yes, good evening. Are you hearing me?
We're hearing you clearly. Go ahead, please.
Okay, good. So Professor Hunter, thank you very much for a very interesting presentation. I'm not sure what I thought tonight was about, but this was not what I expected, but it was very informative and I feel edified for it because I thought we already had a fiscal council in the form of EPOC. So that is my ignorance about our economic structure. But what I wanted to ask, given the negatives, why implement at all? Because as I listened to you, that final chart that you showed, yes, there was a decline in the 90s, but we're on a level. And it's not like we're doing great because we have had a long-standing deficit. But I thought because there would be more tax revenue collected, that somehow it will trickle down to private household, and that would mean greater disposable income where we would see some kind of tax benefit, lowered taxes, which would mean just more benefit to private household. So if the impact is negative to the financial market and also negative to private household, why do you think we should still implement
Yeah. So first of all, the EPOC is different from fiscal council. I think I mentioned that before. But the idea here is that the fiscal council has a particular set of objectives: reining in excess spending, increasing revenues, make budgets more transparent and democratic, so that governments can be held to their commitments. So these are important outcomes, and there's some evidence that that's being achieved. However, the fact that there are these negative externalities simply means that the government, in implementing the fiscal councils, have to be aware of these other possibilities and to find ways of reducing these negative outcomes. It doesn't mean that the positive benefits of fiscal councils should not be pursued because there are some other negative outcomes. As I said, there are other levers that the government can manipulate in order to influence financial development. Because what the statistics essentially shows is the effect of fiscal councils on financial development, holding everything else constant. But in real life, the government won't hold these things constant. Our society won't hold these things constant. So we can pursue the benefits. And now that we are aware of the potential negatives, we can make efforts to reduce those.
Thank you very much for that question. And so another of our colleagues has posted a question, and it is Craig Peru, a member of our staff, and it says, do fiscal councils tend to help reduce financialization? That is the increasing size and importance of a country's financial sector relative to its overall economy.
That's a very good question. So if you look at the results that I present, one of the negative outcomes is that it reduces the number of listed companies. And there's also a negative impact on credit to the private sector as a percentage of GDP. These together can reduce the financialization. However, to the extent that the government, it collects higher levels of taxes, have a bigger budget surplus, there are other ways that the government can actually, outlay that surplus in the economy through projects, for instance, that may increase GDP. And there's a connection between GDP and financial development, which goes both ways. Financial development increases GDP, but greater GDP gives rise to additional financial services. So fiscal councils, the positive effects of fiscal councils and government tax intake can actually lead to a reduction in the financialization, but it may also lead to an increase in the financialization. It depends on the particular situation. The outcome is going to be dependent on to what extent that fiscal councils lead to greater GDP growth and so on. Higher GDP growth, faster movement in the GDP may actually lead to the real sector having a greater role than the financial sector. So financialization might actually decline. But my results would suggest that from the private credit and also from the listed public firms, there could be a reduction in financialization. But I wouldn't conclude that this is the end of that particular story. It could go either way. I can make arguments where it could go both ways.
Okay, thank you very much for that response and question. And I see Venetia Christian Barnes, who has her hand up to ask a question as well. Go ahead, Venetia.
Thank you so much, Indiana. Thanks again, Professor Hunter, for that outstanding presentation. My quick question is, in your research, did you find any outliers or particular case of a country that you did not see the effects, the overall effects of a negative, of a reduction or a negative effect or retardation in terms of the financial markets or institutions? And if there were, what were they doing differently from the masses? What was different about this particular case? And is there anything that we could learn from them?
Yeah, that question can't be answered from the approach that I took. Because we are doing it's a panel model basically, where you are looking at 185 countries together over 40 years. This is not where I look at an individual country on its own. And what happens is that because we only have 50 countries so far that have introduced fiscal councils, it's hard to parse the data more than looking, say, at developing versus developed or Europe versus non-Europe countries. So it's hard to actually do that and to make a definitive statement on that particular question using only 40 years of data. I mean, I could try that, but it's not as easy. And then on top of that general difficulty, the new statistics that is just now being introduced to address the bias that I highlighted has some constraints. And so some of the flexibility which I had when, for instance, previously I looked at whether deposit insurance retarded financial market development, I didn't have that flexibility in modeling this time around. So that's a question I cannot answer, but I would suspect that countries with better architecture, better design features would probably have more positive outcomes or less negative outcomes. And again, the main objectives, it has been shown even though not as rigorous as I have shown here. The main objectives of better forecast, increased taxes and so on, reduce budget deficits, those have been shown to occur across the globe using the sample that we have.
Okay, so the questions are coming in, and I'm mindful of the time. Some really interesting questions. I'm going to start with the one that came last first, and that is from Ralston Samuels. Thank you very much. As Jamaica emerges out of the pandemic, post-COVID era, how can a fiscal council help the government to focus on sustainable public finance?
So that's a really good question, because in the fiscal rules that were mentioned earlier, there's a provision for governments to opt out of the strictures of the fiscal rules under certain specific circumstances, for instance, like the pandemic. So they would incur greater deficit as a percentage of GDP in circumstances like we are experiencing now. Fiscal councils have not to date made that a particular part of the mandate. However, I would expect that the team that represent the fiscal council that are doing the research and the advice to the minister would be providing advice to say, during this special period, if you spend a certain amount, this is the long-term effect that it could have. Let me concretize it a little bit. So in the US, the Congressional Budget Office, the CBO, scores pretty much every expenditure that the government makes, large expenditures that the government makes. So before the spending to provide subsidies during the crisis, there were conversations about the effect on inflation and so on. And the CBO stepped in and gave their recommendations, or at least assessed the likelihood that it would affect inflation. So that would be a role that the fiscal council would play. It would not be overly restrictive to say you cannot provide subsidies in particular periods, and it would not, and it would provide a score for the effects that this would have. But the fiscal council, once established, should be able to rein in spending. And so there's greater likelihood of a surplus that could be deployed in special circumstances, like when oil price goes through the roof, or when there's a crisis, earthquake, hurricane, or pandemic.
Okay, thank you for that excellent question and response as well, detailed response. So we have a question from Lancelot Henry. And Lancelot is congratulating you on the presentation, and he's asking, is there any research done re-comparative fiscal council architectures and the outcomes of these indices?
Certain not in relation to the particular financial development index or indices that I have used. Nobody has looked at that before. But the architecture has been studied relative to some of the the desired outcomes of having better forecast and for instance, fewer errors, providing guidance to the government and helping the government to keep within the constraints of the fiscal council that it pre-commits to. So yes, there's at least one study, I think it's an IMF related study, and that is actually the variables that I have used in the, I think it was a final table, the architecture table, those variables came from that study because they said those variables are the ones that are critical. I did not include some other variables that are characteristics of the fiscal council, but beyond that study, I'm not aware of any other.
Okay, thank you so much. So we are.
Let me just say, one of the reasons perhaps there isn't a lot of study about that is the nature of those studies, of those variables, is that you have to do a little bit of the econometrics, a little bit of a cross-sectional relationship. So it's harder to make causal statements. It's basically correlative statements as the ones I have made with that particular table. So it's less attractive to researchers.
Okay, thanks, Prof. Hunter. And so Nicholas Michael, I think we're winding down. Nicholas Michael has a question. One of the bigger.
By the way, I am fine if people want to ask more questions. You will have to decide.
Okay.
How long you wish to keep.
Well, thanks for letting me know that, Delroy. So Michael's question, one of the bigger negative impacts highlighted was a reduction in access post-financial counsel. Professor, did you find out the possible cause of this? Thank you.
I didn't get the first part.
So let me go again. One of the bigger negative impacts highlighted was a reduction in access.
Yes, okay.
Post-financial.
I get the question.
Yes.
So if you think about the fact that in the crisis period, just to highlight a situation, the crisis period, there was a lot of discussion on the TV in the US that people who are getting these stimulus checks were engaging in financial transactions, trading stocks, buying derivatives, etc., etc. Some of them for the first time in their lives. Yeah. We know that government funding increases market participation. There's a study by D.A.U. et al. In Journal of Financial Quantitative Analysis that shows that states in the US that pay out when in bad times tend to generate more market participation in the stocks whose headquarters are in those states. Yep. So you can imagine if there is a reduction in those payouts, those government support, yeah, then that may reduce participation. But you don't even have to get that sophisticated. If you have individuals who obtain certain subsidies or make certain revenues through legitimate work, contracts, etc., from the governments, or even less strenuous tax collection by the government, so they have a little more income than they would if all these things were the opposite: more strenuous tax collection, no subsidy from the government, etc. So if you have more income because of part subsidy from the government, then you could have more surplus, more savings that you'd keep in banks, put in pensions, etc., etc. Once there is a reduction in these additional inflows, then your savings decline. Your savings could decline to the extent that you reduce your participation in pensions, that you reduce your savings in bank accounts, your credit unions, etc., even in partners. Consequently, you would have less demand for financial services, and areas that are hard hit, for instance, certain states or certain areas of the country with hurricane damage, etc., without government subsidies, you could have significant disintermediation by these investors or individuals who are no longer getting the subsidy. So that's one channel, just a reduction in assistance, government assistance or government support, and therefore a reduction in taxes, a reduction in savings and/or investments. And that translates to lower demand for the services offered by some financial institutions.
Okay, thank you, Prof. Hunter. So there's a final question, and this goes to Andrew Russell, who's asking, Given the political environment, do you believe that policymakers would exchange discretionary fiscal management for rule-based fiscal supervision of public finances?
And my answer to that is yes. As far as I'm aware, Jamaica is in the process of writing legislation to introduce a fiscal council. I know Damian King, Dr. Damian King at UWI, told me that Capri did some sensitization about that. So I know that's happening, and I would think that both parties have signed off on it. So why would they do that? Because by having a fiscal council, you can actually send a signal that you're a smart politician. The fiscal councils will assist you to make better forecasts. And to the extent that you can make better forecasts, which can reduce your excessive expenditure, increase your income, you can do other things, for instance, infrastructure projects, etc., etc. So there are some benefits of politicians, both practical and some conceptual benefits. If I had time, I could talk about some of those. But yes, there are some potential benefits that they may give up this discretion, because if nothing, it can actually make them look better. If their forecasts and expenditure tend to be better, and their forecast and actual collection of revenues turn out to be improved in the post-fiscal council period.
So, Prof. Hunter, I said it was the last question. You did say you did say you're also willing to continue a bit longer. So I don't know if it was me saying the last question prompted two other things to come through in the chat. So we have a colleague here, Cleopatra Gittins, and she's congratulating you on a very interesting study and noting that it has piqued her curiosity as to the results that would be obtained from similar research, such as this across the Eastern Caribbean Currency Union with its 8 islands. And then Suzanne Winter. Hi, Suzanne. Excellent presentation, Prof. I came upon the presentation would seem to indicate that the effectiveness of a fiscal council requires a strong governance structure, staff, with persons with strong technical skills and independence. Jamaica, being a small country with various resource limitations, would face an inherent resource risk. Are fiscal councils specific to a country, or can they operate as support for many countries, especially for smaller economies?
So in the Eastern Caribbean, with this currency union, I could see a fiscal council having it's a joint entity. I suppose that the fact that you have a currency union would, to some extent, but not necessarily to a great extent, increase the efficiency of a fiscal council and perhaps reduce some of the potential negative outcomes. But it is not clear how a currency union would actually make a difference. What would make the difference is probably how it is staffed and the mandate that is given. But the fact that you have a currency union already might mean that it's easier to share information, and you could have one entity for these multiple countries, and there is probably some already built-in stability in order to maintain this fiscal council, and so the deficit bias of governments may be a little less in these places. The other question about strong technical skills, there's definitely the need for that. This is not just oversight, but technical involvement in evaluating fiscal budgets and doing forecasts and so on and so forth, and making comments and interacting with the public. So that is something that needs to be taken into consideration. there was actually a question in that last table I done looking at the architecture. There's actually a question on the involvement of foreigners. And I think it was a negative sign. I didn't pay much attention to it. Those are not the ones that were shown to be most important based on theory. And the involvement of politicians was also positive. I can answer that, but I would think that if a government goes through the trouble of establishing a fiscal council, they'd want to make sure that there's adequate staff and expertise involved. Otherwise, it's just a waste of resources and a waste of time. And it's unlikely that the benefits would be extracted from it as would be desired.
Okay, thank you very much, Professor Hunter, for your patience, for your excellent work that you shared with us this evening. Really a lot of food for thought. I see a lot of persons have remained online to hear the questions and to hear the responses. So it's an indication of the level of interest and the value that we place in the work. So I want to thank you so much for the time spent in Jamaica. Thanks to the Fulbright program for facilitating you conducting this research. And I'm actually looking forward to the next steps, because I hope this is not the end of it, and to hear far more about the impacts of the research and the application as well. I'm going to ask Professor Hunter just to put his email address in the chat, because I suspect, especially given that many of you have still stayed on, that you may still be interested in hearing more about the research or reaching out to him directly for any questions that you may have that you didn't want to pose this evening. And so that leaves me really to thank you for being such a wonderful audience this evening. Thank you for being such a participative audience. Thank you for the questions that you asked. Thank you for coming to join us at the Muna School of Business and Management for this session. Thank you to our Executive Director, Dr. Matt Bean, who brought words of welcome earlier, and to the team that helped from marketing and IT to put this event together. We at the MSBM, we do look forward to hosting you on these sessions. This is a part of our engagement and our outreach to our various communities and stakeholders. We invite you to stay in touch with us via our social media platforms, through our email and telephone contacts, however you may wish. Please do, if you don't know about our suite of programs and services that are offered by the MSBM, please have a look at our website and reach out to us. To those who are on Facebook, I believe, thank you for joining us. I really do hope that you found this session as interesting as I have found it. And so without further ado, everyone take care, enjoy the rest of your evenings, and please share the work in your various contexts, work contexts, classrooms, wherever you may find yourselves. Thank you so much. Thanks again, Prof. Hunter.
No problem. Take care.